What's up, everybody? Welcome back to the channel. Today we're going to be talking about using exchange traded funds, ETFs. So who uses ETFs? Pretty much everybody. Hedge funds, banks, endowments, investors, traders, 401k contributors. They're one of the most widely known kind of assets within the stock market, and they were pretty revolutionary back in the 90s when they were first introduced. So what to look for when you're using ETFs? What's the thesis behind the ETF? Is it a value ETF? Is it a growth ETF? Does it hold large cap stocks? Does it hold small cap stocks? And then there's also a little bit more specific ones you can go into, such as ETFs that focus specifically on dividends and trying to optimize for dividend yield and dividend growth. Next thing to look for is what's the expense ratio. What the expense ratio means, it's the cost to own the ETF. All these companies have to, spend time researching the stocks they put into their ETFs. They have to spend time updating their research. They have to spend time managing how large that position is. So there's going to be a cost to own the ETF. Even if it's, something that just matches an index, they still have cost of employing people to run the ETF. There's cost to list the ETF. There's cost to manage the servers and the offices and keep everybody on staff at that company. So that's why there's going to be an expense ratio to go along with that ETF. And you want to make sure that you're in the least expensive ETF that you can be that matches your investment needs. Next thing to look at is the ETF active or is it passive? An active ETF is going to have a lot more turnover than a passive one will. And by turnover, that means the stocks that are within that ETF, how long are they usually held? In a passive one, you're really not going to have that much turnover. Maybe a couple times a year, you'll have a stock go in or out. But an active one could have, changes every month on what's the top weighting, what's the lowest rating, what's in, what's out. So it's important to understand what the thesis behind the ETF is and whether or not it's an active or a passive thesis. Next up, you have a cap-weighted or equally weighted ETF. Cap-weighted means that the percentage that a stock contributes to an ETF is based on what the market capitalization of that stock is. So if you have 10 components within ETF and say, one stock has $1 billion market cap, one has a $500 million market cap. The one with a $1 billion market cap is going to have twice the rating or twice the weighting within that ETF compared to the one that only has a $500 million market cap. And then equally weighted means if there's 10 stocks within the ETF, all of them have a 10% weighting. It doesn't matter what the actual market cap of that stock is. All that matters is what the total number of stocks within that ETF is, and then it takes the average. And then the last thing to look for is what's that rebalancing frequency. So when you're in an active ETF, it's probably going to have a lot higher rebalancing frequency than if you're in a passive ETF. One of the common active ETFs is the ARK fund. So Kathy will often go through and buy stocks every single day or sell stocks every single day. So there's going to be a lot of rebalancing associated with that ETF. When do you own an ETF versus individual stocks? So ETFs provide a lot of diversification, and they do this a couple different ways. So right off the bat, you diversify by reducing your individual stock risk. Even though, let's say you're looking at, a spider sector ETF like the XLK, the technology sector. Obviously Apple, Microsoft, and NVIDIA are going to have a large weighting within that. But when you buy the ETF, you don't have to worry about one of those stocks missing earnings. It's going to be offset by the fact that it does not have 100% weighting within that ETF. So that's one way that you can reverse diversification. Less knowledge required when you're using an ETF versus individual stocks. You don't have to follow every single stock within that ETF. It kind of just gives you a general sense of how that trend is moving within the individual components of the ETF. And then finally, liquidity is a big factor. If you're looking to get into, a more low-key sector of the market, you can often use an ETF and get a basket of all those individual options, and then it'll bundle them up and give you a vehicle to trade those with. Some of the downsides of ETFs, because you have all these different components within, and even if you're a market cap weighted ETF, you're still going to have less returns than best components. So what that means is, let's say that you have a stock that's up 100%, but then you're going to have stocks that are up 80%, 60%, maybe even 10%, or maybe some are negative 20%. So ETF as a whole is going to do worse than that individual stock is, just because of the fact that it's bundled into an ETF itself. So that diversification also brings with it just the inherent risk that you're going to have less returns compared to the best components, but it's also going to give you exposure to those best components and the chance that maybe you weren't looking for them in the first place. Another downside of ETFs is they'll break out after the best components have already broken out. This is a lag effect. So, NVIDIA has been a really big performer over these last couple of years. This one recently broke out, but the technology ETF did not break out at the same time that NVIDIA did. There were other components within that sector that had not started to break out at that same time. So what you're going to see is that the ETF lags behind its best performers in time and in percentage returns. Another downside is when the largest weighting of an ETF is out of favor, it's going to drag down that ETF proportionally to how much it's weighted. So Tesla's been a big underperformer these last couple of years, and it's been a drag on the XLY. Just something to think about. If you have a market cap weighted ETF, and say you have a single component that's worth 50% of that whole ETF, you're really going to see that large singular component have the largest, it's going to match that component the most, like the price returns are. So you want to make sure that you're looking at those weightings and understanding those risks, those single stock risks that come with an ETF. And then lastly, very specific ETFs can lag behind a market index ETF. So the ARK Innovation Fund, this is kind of the flagship fund, and it kind of has more growthy, more speculative type names. Even though they're large cap, they haven't been in favor as much as some of the large cap tech stocks have been that are making up the SPY component. So that's where you have to be careful when you're picking very specific ETFs. You want to make sure that you understand the risk behind them and understand that they can lag the market index ETFs. And then where you can find ETFs, here's 4 links. I'll make sure to post these in the comments. So yeah. Now let's take a look at some ETFs themselves. So here are the most common ETFs. For the S&P 500 index, you have the VOO. This is the Vanguard S&P. And then you have the SPY. That is the S&P 500, the Spiders ETF. Next up, you have the Dow Jones, the DIA, the NASDAQ is the Qs, and then the Russell 2000 is the IWM. So let's take a look at some of these charts. Obviously, you're going to have a very similar layout for the VOO and for the SPY, just because they are the same index. The only thing that's going to be a little bit different, if we take a look at these charts, here's the VOO and here's the SPY. The only thing that's a little bit different is when they pay their dividends. So you're going to see pretty much an exact chart. They both bottomed back on October 27th, and they're both currently ripping to all-time highs. And this is just because they're made up of the same exact components. So that's why the chart looks the exact same. When you go to the DIA, on the other hand, this is the Dow Jones Industrial Average. This one is only made up of 30 stocks. And you can see just the slightest changes in the price action. Back here, pretty much we'll call it from the middle end of December until recently here, for that month from the 20th of December to the 20th of January, there really wasn't much volatility. But when you look at the S&P, you see a lot more volatility in these dips. When you look at the Dow Jones, it mostly just traded sideways. But at the end of the day, a lot of the components that make up the Dow, all of the components that make up the Dow are also in the S&P, and they're also, close to the same weightings. So that's why you get really the same general trend. And then when you look at the Qs, same general trend, just a lot more volatility. This is all technology. a lot more than at least the Dow has, and especially and also more than the S&P has. So just to change, these are all large cap. VOO and SPY, same thing. DIA is the Dow Jones large cap, and then QQQ is the technology large cap. But then we can look at the IWM. This is a small cap index. You can see there really is a different trend in these stocks. We did get the big rip in November, but recently these have been pulling back and have yet to make new all-time highs. But when we look at the Qs, we're making new all-time highs. Look at the Dow, we're making new all-time highs, and when we look at the SPY, new all-time highs. But small caps aren't confirming that. So that's where these different ETFs can provide you with different trading opportunities. And it also adds another layer of when to get into one ETF compared to another. So going back to the PowerPoint, the most important ETFs, in my opinion, are large cap technology, semiconductors, home builders, and then the securities broker dealers. So large cap tech is the largest component of the S&P. Semiconductors drive the entire world. Everything that goes on in this world requires semiconductors. So if the semiconductor are performing well, then the rest of the world is performing well. If large cap tech is performing well, then it makes sense that the S&P as a whole would be performing well. Home builders are more speculative stocks, and when they're going up, it means that the economy is doing well. If people are buying homes, if these home builders are demanding a greater value than they had in the last few months through price appreciation, then it means that the consumer as a whole is doing well and the economy as a whole is doing well. And then security brokers, these are important to me because these are the stocks, the companies that represent active trading in the markets. And if these stocks are making new highs or new lows, it lets you know how market participants are viewing the market as a whole, because if they're willing to buy stocks that have direct exposure to people buying stocks or lack thereof, then these companies having greater earnings, having greater price appreciation, goes to show that more people are interested in stocks and assets as a whole. And since these companies are directly tied to making money from people exchanging assets, if these assets are going up, then it makes sense that the economy as a whole will be going up. So let's take a look at some of those. Here's the XLK. Looks a lot like the Qs because it is a technology fund. Here's SMH. This is another technology fund, so it looks the exact same. And then let's take these to a weekly chart. So you can see the XLK been making a series of higher highs and higher lows ever since it bottomed out in September of 22. Same thing with SMH. And then ITB, we get the same sort of thing. Everything's been going higher this whole time, so it leads you to believe that the economy and the stock sector as a whole is going to do well. And then here's broker dealers. Again, everything is pushing against new all-time highs and looking to break out even more. Next up, we have the sectors, the 11 sectors of the S&P. These are something that you're going to want to look at every day. These are very important, and they break the S&P into different sectors this way, through technology, through financials, through healthcare, consumer discretionaries, industrials, communications, staples, energy, real estate, materials, and utilities. When people talk about sector rotation, this is what they're referring to. As money moves from one sector to another, it's going to be looking to see where it can go. So we looked at the XLK already. That one's been making higher highs and higher lows. You're seeing the same thing in financials, the same thing in healthcare. But then we're getting kind of a divergence here with the XLY, the consumer discretionaries. This one looks a little bit more like small caps, but small caps haven't really broken out of their most recent base, while discretionaries have. So that's something to take note of. There is a little bit of a divergence between the XLY and these three other sectors that we've already mentioned. Here's the XLI. That one's making new all-time highs. XLC, new all-time highs. XLP, this is more your defensive names. These are your staples like Coca-Cola, Procter & Gamble, Colgate-Palmolive, Pepsi. This one took a pretty big drawdown, and it's just now recovering. So you can see different sectors are going to perform differently when you have different market environments. Energy has been a consistent laggard. That's in a downtrend. Real estate, still in a downtrend after making recent highs back in December. Materials look a lot like small caps. Utilities have mostly been trading sideways. They made a pretty good run off the October lows, but ever since then they're trading right around where they were back in October. So that's those are the 11 sectors of the S&P. Those are their ETFs. Then next up we have bond ETFs. The three that I follow closely are the 2-year note, the 7 to 10-year note, and then the 20-year note. So if you know anything about intermarket analysis, there's times when stocks and bonds trade with a positive correlation and times when stocks and bonds trade with a negative correlation. So recently we've been seeing a positive correlation between stocks and bonds, meaning when stocks go up, bonds go up. When bonds go up, stocks go up. And then when bonds go down, stocks go down. When stocks go down, bonds go down. So with this positive correlation being pretty evident over, these last 2-3 years, it's interesting to see that stocks are making new all-time highs while bonds are kind of pushing down to their lows, looking more like small caps here. And that's consistent throughout the 3 different durations. It's important to watch different durations of bonds just to see how the risk appetite is. Right now, the 2-year and 10-year bond curve is currently inverted, meaning that you get a higher percentage return on your bond from the 2-year than you would a 10-year, which from a risk management standpoint doesn't make any sense. If you're willing to buy an asset with longer duration, you should be rewarded with greater yield. But right now, there's so much uncertainty that people are willing to pay less for a longer duration than they would for a longer duration. So something to think about, and bonds are a great way to track that. It's a whole different asset class than stocks are. These are debt issuances, and for most of the 2000s, stocks and bonds traded at a negative correlation. So when stocks went up, bonds were down. When bonds were up, stocks are down. And it is a way to diversify your portfolio. But since we've been in this inflationary environment, stocks and bonds have been trading at the same rate. So they haven't been able to diversify or protect downside risk. So that's something to take note of. And these are the 3 ETFs that I use to track those different duration bonds. Next up, we have technology ETFs. We've gone over a couple of these already. The Qs are the large cap technology. XLK is large cap tech within the S&P. Then you have small cap tech. You have cybersecurity funds, you have software funds, and then you have internet funds. So looking at QQQJ, this one looks a lot more like the small cap Russell 2000 ETF than it does the large cap NASDAQ ETF. And you're seeing that because small cap tech has yet to make a breakout to new all-time highs like large cap tech has. Cybersecurity is stocks like Palo Alto Networks, Zscaler, and CrowdStrike, and these have been some of the best performing stocks that we've had this year. IGV is a software tech ETF, and then FDN is just a general internet index fund. So these are different technology funds that you can follow. They all have a little bit different thesis and expense ratio behind them, so it's important to see exactly what the components inside these ETFs are and if they track the market participation that you want to be in. Next up, we have more speculative growth ETFs. This is all the ARK funds. You have different IPO funds, different biotechs, and then the IBD 50. So looking at these, you can see that this looks a lot more like small cap just because these are companies that don't have the pricing power that some of the larger cap names do, and they don't have possibly the balance sheets that other larger cap names do. Maybe they don't even have earnings. So when you're doing these more speculative growth names, you need to take all these things into account, and this is where you can see that underperformance compared to other technology funds. So since XLK is making new all-time highs, but you're seeing ARK isn't, you're going to underperform that large cap tech ETF, and you need to be willing to change your thesis and get into the names that are going up. And then here's just a couple different ones. ARK is the innovation, ARKF is the fintech, and then ARKG is the genomic. Here's the IPO fund, looks a lot like ARK. FPX is a little bit more diversified IPO, and it's getting closer to making, a new cycle high, but very far off those all-time highs. XBI, biotechs were looking pretty hot, but now they're not looking as great. And then IBB, another biotech, again, mostly just been trading sideways. And even though the XBI is a biotech ETF and the IBB is a biotech ETF, they have different weightings within them. So it's important to look at those weightings and see, is it weighting higher on a worse performing stock, and is that why the ETF is lagging behind another one? And then Genome, this one's been even lower. This one's a lot more like RG, and you can see how similar those charts are. And then the 50, this one is a little bit more of a momentum ETF, and that's why it's a lot more active than some of these other ones are. And you can see that it's been outperforming over these last few weeks, and that's something to take note of. You want to kind of dig into these components if you're wanting to, use this ETF as a broad barometer of speculative growth, and then you can see what the best performing components within this ETF are and try to get involved in those. And then lastly, we have our dividend ETFs. The four I choose to highlight are listed here, and here's their respective yield. So if you don't want to, have to try to pick your dividends, if you want to find a fund that'll do the research for you, this is the easiest way. And you can see, these chart patterns more or less look the same, with SEPs being the greatest difference between the four. If you go back to the yield, you can really see that, SEPs kind of outpace in yield, and a lot of your return in this ETF is just going to come from dividend yield. You'll likely get very limited principal growth. Something to note, it's kind of hard to find a stock that's going to yield you 3.5 to 4.5%. 1.99, 1.77 is close to what the S&P pays. It's a lot closer to 1% for the S&P. So these yields are at least 3 to 4 times to 9 times higher than what the S&P is paying you. So the general rule of thumb is you want to withdraw 4% of your retirement account. If you take 4% out of your account, that's kind of the most conservative, smartest way to do that. So if you're able to get in this Invesco high fund yield and you put, let's say, $1 million, you'll be able to pull out $40,000 just from the dividend yield, and that's all going to get paid to you. So it's kind of a way to really limit your individual stock risk within those dividends, and that way you can still get that yield you're looking for. So this is, a non-exhaustive list of all the different ETFs. If you're looking to kind of, add these to your watch list, take a second and pause the video, start looking at all these. I'll scroll down in a moment. Here's the rest of the list. These are just a few of the ETFs that I watch. I watch a lot more than this, but it's a good way to get a general gauge of the market and save you a lot of time by not having to look at all these individual components. So thanks for watching. If you have any comments, feel free to put them in the chat below.